Well, I'd like to begin by thanking the organizers for putting our paper on the program. It's an honor to be here. And I was really happy that Wofu and Sean's papers were before ours today because they're actually quite related. At least parts of them are quite related to some of the things that we're doing today. So Wofu showed that intangibles are really an important um, uh, part of a stochastic discount factor. And Sean talked about biases and earnings expectations. And we're finding that part of our results, not all of them, but part of our results are related to that. So a number of people have looked at earnings as a determinant of a pricing factor. It's a long literature. In particular, we stick pretty close to the Fama-French measure of profitability, which is called robust minus weak, which, just the name robust minus weak suggests quality. We're long, high quality things, and we're short things that are low quality things. Now, one of the things about most of those earnings factors that have been proposed is they're based on GAAP earnings. And an important aspect of GAAP earnings is that the GAAP earnings treats investments in intangibles totally different from investments in physical capital. So physical capital gets capitalized and depreciated over time. Investment in intangibles through R&D, or let's say we're building a brand that's showing up in our SG&A expenses, that gets expensed right away. So we thought to ourselves, well, why don't we look at a variant of Fama-French, and we'll talk a little bit about why that one in particular, and adjust for intangibles, do what they do, except redefine what earnings are. And what we find is that the adjustment improves the performance of the profitability factor quite significantly. So if we regress our earnings factor on, for example, the Fama-French 5 model, we have a 3% or 2.9% annualized alpha when we do annual rebalancing of our factor. When we go to monthly rebalancing of our factor, there's a 6.6 alpha relative to the Fama-French model. What we find is that this is a very nonlinear kind of factor. So one thing is it has a negative beta, which is common amongst earnings factors. So it actually does relatively well when the market goes down. But there's a put-like feature. So we show that in addition to having a negative beta, there's a kink. So the beta is really negative on the downside. So our factor almost has a zero beta on the upside, but has a negative beta on the downside, which seems like great. I love that kind of put insurance. Okay. So part of our results are consistent with the dividend discount model that Fama and French use to motivate some of the choice of some of their factors, but part of it isn't. Okay. So what we show is that the source of the performance is totally different on the long side of the factor versus the short side of the factor, and that also analogously, in terms of a difference, the bias in earnings really is coming from earnings expectations. It seems to be driving what's going on the short side of the factor. Okay, so why might this adjusted factor explain returns? We're using Fama-French, but symmetrically treating physical and intangible capital. There's no real reason why they need to be treated differently. And we'll show some intuition from this dividend discount model. We divide time into sort of half, the first half and the second half. It's stronger in the latter, but it exists in both periods. The performance isn't due solely to the long side or the short side. What we're going to be seeing is that the short side has a different source of performance than the long side. A lot of people worked in this area. In the interest of time, I'm not going to go through a bunch of those. So Fama and French motivate their choice of factors in the Fama French 5 through a simple dividend discount model and sort of clean surplus accounting. So the price today is the expected value, the discounted value of dividends, where dividends are expected dividends are expected earnings minus retained earnings. And when we scale both sides by book value, the current book value, we get this relation which says the price to book ratio is related to the expected future values of earnings scaled by book and retained earnings, all discounted at the implied cost of capital. So all the 5 factors in the Fama French 5, except for the markets factor, is motivated by the CAPM, but the other 4 can be motivated by this relation. So what this relation shows, this is not an equilibrium statement, it's just correlation, cross-sectional correlation, that holding other variables constant, the firm should have, in order to get this equation to balance, the lower the market to book, or the higher the book to market, the higher the future expected returns need to be, the higher the R that's being used to discount that. The higher expected profitability, then the higher the discount rate has to be. The lower the expected growth, then the lower the expected growth, the higher the expected R to equilibrate both sides of this equation. And then holding, again, other things equal, the lower the market value of the asset, the higher expected return. So we have essentially, value, we've got the earnings factor, we have the asset growth factor, and we've got size, all in this relation. So there are different ways to think about earnings. So we can think about from very top line, just revenue. You can think of it as revenue minus cost of goods sold. The second one is a factor that's proposed by Robert Novi Marx. And then I'll go down a little bit below the box. Then we have Fama French, it's revenues minus cost of goods sold, minus interest, minus SG&A, which includes both standard SG&A plus R&D, and then all the way down to basically net income. So pardon me, but I'm using a lot of CompuStat nomenclature here. In the middle, what we're doing is we're taking Fama French and we're adding back R&D expenditures in the line right above the Fama French measure. Then we also add back 30% of SG&A, which is related to some suggestions that Luke makes in his work. And then we looked at what happens when you add back all of SG&A in addition to R&D to define earnings. Now we're going to sort on these earnings measures and basically take a long position in the top 30% of earnings and short positions in the bottom 30% of earnings, and then see what happens. So one of the requirements for this to be consistent with the implied cost of capital explanation of things, the expected return explanation of things, is that these variables should be able to predict future earnings. So there's a lot more detail in the paper. Luke had to go through with the Internet appendix over 100 pages, so my condolences. But one of the things that we show here is that the Fama French measure can predict long-term, these R squares are cross-sectional R squared, far into the future, going out 10 years, the cross-sectional difference in returns. And relative to all the gap measures of performance that we looked at in that previous slide, Fama French actually does the best. So that's sort of why it's our starting point. We want to try to beat the best. On the right-hand side, we have our variable, which is taking the Fama French measure and just adding back R&D. So we're not doing anything with SG&A. That helps a little bit, but I'm not going to go over that right here. So what we see is that early on, going out 1 year, 2 years, and so on and so forth, the Fama-French measure does a better job of predicting cross-sectional difference in operating cash flows. But then things switch. And so we have higher R-squareds going out, if we go out, for example, to year 4, year 5, and so on and so forth, our intangible adjusted measure does a better job of explaining cross-sectional differences in future operating cash flows. And some of those are significant. Okay, so this is one that gave us some hope that we might have some ability to create a factor that does better than the Fama-French factor. So what we do next is we're going to calculate the alphas of these various earnings factors relative to the Fama-French 5. So the dash curve, that's the mean return, and the solid curve is the alpha relative to the Fama-French 5. And on the furthest to left is bottom line, that's net income. And then net income adding back special items and so on and so forth. Fama-French is the fourth one over. And then the next three are our measures. And then finally, the Novi Marks measure is the penultimate one, and then top line revenue. So what this shows is that our three measures have a much larger alpha. Well, the Fama-French measure shouldn't have any alpha relative to the Fama-French 5. So that's by construction. That's not a knock against the Fama-French earnings measure. But ours has larger alphas, a larger mean return, and higher t-statistics of the alphas than the alternatives. Then we run a horse race of our earnings-based factor against a whole array of various models. I showed you in the graph against Fama-French 5, but here we have these are the mean returns, and then alphas. So alphas against Fama-French 5, Fama-French 5 with a more cash-oriented measure of earnings from their 2018 paper. Fama-French 6 is adding the momentum factor of Carhart. Then the Asnes and Frazzini devil in the details. We're substituting in Fama-French 6 devil is substituting basically the value factor with a more frequently updated one, and so on and so forth. So SY is Rob's model with Yuan. And so these are monthly alphas and the associated t-statistics for both adding back R&D and then adding back R&D plus a third of or 30% of SG&A. So the alphas are positive against all these alternative models. They do better when we do monthly rebalancing, so we're updating more frequently. So against a whole array of models that are out there in the literature, some of which actually try to incorporate intangibles, including the last two, we're seeming to outperform them. So what's another property that we want to look at? Well, if we're going to motivate this as quality, we want to factor, we're going to relate the factor to how well does it do when things go bad. So we have in this diagram, we're looking at earnings factor based on net income, the Fama-French earnings factor, and then our R&D adjusted factor. These are the average returns and t-statistics over the full sample. That's the first set of numbers. Then we look at what happens when the market is up versus when the market is down. Okay, so when the market is up, the net income earnings factor and the Fama-French factor have slightly negative returns, but insignificant. Ours has a significant positive return. We'll come back to that. But the really interesting thing about all of these is that they have higher returns when the market is down. So when the market is down, the net income factor is earning a significant 1% rate of return per month. The Fama French factor is earning 1.08, and we're earning 0.7%. So all these earnings-based factors are showing some quality metrics because they do better when things are bad. And this chart basically shows us what happens when they really start getting worse and worse and worse. So what happens in months when the market is down by 5%? What happens in months when the market is down by 7% or 10%? And what this table shows is that each of these factors starts having higher and higher returns the more negative the market is. So I'll show you in a bit that a lot of that's coming from the short side really doing horribly. Okay, so we want to split the sort of what's going on with performance into what's known as security selection. Are we just picking great assets? Versus market timing. And the way we do this is from running what's called a Henderson-Merton regression, which allows beta to vary depending on whether the market return is above or below the risk-free rate. So we're just going to take the factors. So we're looking at Fama French, we're looking at our R&D adjusted measure, we're looking at the Novi Marx measure. So we have an intercept, that's our selection alpha. That's the performance due to just picking good assets unrelated to what's going on in the market. Then the next slope term is what we call beta super up times the excess return on the market. And then we have another beta times the max of the negative of the excess return on the market and 0. And what Henderson and Merton show is the interpretation of this regression is that beta up, the first slope coefficient, is what is the beta in periods where the market's earning more than the risk-free rate. And then what they show is the second slope coefficient, beta up minus down, is the difference between the up market beta and the down market beta. So if a strategy is a good market timing strategy, this was originally developed to evaluate market timing performance of mutual funds. But you think about it as factors. Does the factor have any market timing ability? We want factors that have higher up market beta than down market beta. That's what we're looking for. So we're looking for positive selection alpha, and we're looking for positive up minus down beta. We want higher up market betas than down market betas. And all of these assets or strategies, or most of them, have positive selection alpha. And ours is the strongest up minus down market beta. So we have a positive up minus down market beta, meaning that the beta on the short side, on the long side, is higher than the beta on the short side by 0.14, and that the coefficient is statistically significant. What we then do is split it between the long side and the short side of the strategy. So long side are high earnings firms, the top 30%. And what we're seeing, something here that's quite interesting, is that the source of the performance on the long side is completely different from the source of the performance on the short side. If we look at the long side for our intangibles adjusted measure, which is in the middle, all the performance is coming from asset selection. So we're picking good stuff that works all the time, but so there's no market timing component to what's on the high earnings component. So also looking at the long side, we go to the third column, which is the up minus down beta. There's absolutely no market timing going on here. In fact, the coefficient is negative, but it's insignificant. If we look at the short side, well, on the short side, if I look at the selection alpha, there is absolutely no selection going on here. We're not picking great stocks on the short side that are gonna outperform no matter what happens. But we do have, so this is long the short side. So I told you we want a positive up beta versus down beta. We're having negative, significantly negative up versus down beta, but this is the long side. That's what would happen if you went long the short side. So if we go short the short side, well then the difference in beta between the long and short, the difference in beta between up and down market betas is 0.17, and statistically significant. So all the performance on the short side is coming from market timing. So on the short side of these earnings factors, that what's happening is the short side, the low, ex ante earnings firms are getting crushed when the market is down. Okay, so whenever we have a factor that gives me some alpha relative, some asset pricing model, but an important question is just some risk. There's some other price factor that we don't have in the model, and so this is just beta relative to that other factor, or is it some mispricing? So we try to look into this through a few ways. One is we look at analyst earnings forecasts here. So this is very related to Sean's paper. We look at analyst forecast errors and ask, does lag profitability, the profitability that's going into this factor, really just reflecting the fact that there's some biases in the earnings forecast? And then we asked, if we start now putting into these predictive regressions, the simultaneous earnings forecast errors, does it drive away our factor? We also look at implied cost of capital, right? If the high earnings firms have higher return in a rational asset pricing context, they should have a high implied cost of capital. The low earnings firms should have a low implied cost of capital. So we go through, we average 4 different measures of implied cost of capital to use our measures. The same approach was used in a recent paper by Lasse Pedersen. And then we look at what happens to returns around earnings announcement dates. So if people are getting surprised, let's say, for example, if the short side has upward biased earnings and they're getting surprised when things don't happen, does that show up around the earnings announcement dates? Sort of related to this issue of stickiness that we saw later today and expectations, we're seeing not much is happening. Okay, so this graph shows you the difference between the forecast earnings at various points in time relative to the day. So we're looking at analyst earnings forecast errors relative to date 0. Date 0 is our portfolio formation date. And the 2 top curves are the Fama-French 30% of RMW. The other curve at the top is our measure, our intangible adjusted measure for the low earnings firms. The 2 bottom curves are Fama-French expectation errors and ours for high earnings firms. So one thing we see is that these are on average positive, and there's a long literature in the accounting. There's a long literature in accounting going back to a paper in the 80s by Patricia O'Brien that shows that analyst forecast errors tend to be biased upwards. And this is an issue that I think Ray talked about in his discussion. Are these true expectations? But I think the important thing is the difference between the two. The difference between the two basically shows that for the low earnings firms, analysts have pretty severely upward biased earnings estimates. whereas the bias is much, much smaller for the high earnings firms. So this might explain why the short side helps our strategy so much, because the expectations embedded into the price are just, the price is too high relative to, a rational estimate of what earnings are. Okay, so what we do next is we sort of forecast error. So we have EQ is the forecast error, which is the consensus forecast from IBES minus the actual. Going out, EQ1 is 1 quarter, EQ2 is 2 quarters, and so on and so forth. And we have a bunch of controls in here. We've got size, we have market to book, we have lagged returns, we have asset growth, lagged asset growth. And then we have 2 dummy variables. So the second to last column is a dummy variable, which is 1 if you're a low earnings firm, and and 0 otherwise. And then the last column is a dummy variable, which is a 1 if you're a high earnings firm. So if we look at the second to last column, the coefficients that we're interested in are these the ones on the dummy variables. But for the low earnings firms, the dummy variables are all positive, and they're all significant except for going out to the fourth quarter. So what this says, the dummy variable being positive, says the forecast is higher than the actual. They're upward biased estimates of earnings for low earnings firms. The coefficients on the high earnings firms, sometimes positive, sometimes negative. None of them are ever significant. So there's not much evidence in these data that suggests that the high earnings firms, that the biased earnings expectations are for high earnings firms. They're more for the low earnings firms. So another thing we do is take sort of that same regression and then put in the contemporaneous forecast errors. And then we want to see, does the putting in the forecast error, so this is no longer a predictive regression because the forecast errors are contemporaneous, does it drive away the ability for high earnings, low earnings, these dummies to predict returns. So what's on the left-hand side here is not forecast errors, but returns. And we see in the first set of regressions without the forecast errors, we have a negative coefficient for the low earnings dummy, and a positive coefficient with the high earnings dummy, which is just saying going long the high, short the low gives you high returns. But then when we put in the forecast errors drive out all the explanatory power of the low earnings dummy. But it does nothing really to the high earnings dummy. Okay, so this is another indication that the biased expectations are driving sort of what's going on in our results. Okay, so there are other things about the implied cost of capital and earnings announcement dates that I don't have really time to talk about, except that like Sean's paper, we didn't really find that the earnings expectations were revised around earnings announcement dates. Okay, so the evidence aligns with biased beliefs on the short leg. Analysts are over-optimistic for low earnings firms. So let me conclude by saying incorporating investments in intangibles helps us create a better mousetrap in terms of a factor that has higher returns, negative beta, and also a put-like feature. So I think about those as sort of being incongruous together. And so half of that on the short side seems to be due to biased expectations by security analysts and the market. Thank you.
I realized that being the last speaker before lunch, the real intangible asset in this room is your patience. And it's depreciating very fast. So I'll be efficient. I enjoyed reading Bob's paper. I recommend it to everybody. I think of the paper as telling us that better accounting can lead us to better asset pricing. More precisely, by treating companies' intangible investments in a more sensible way, when we look at the accounting data, that can help us build better models for explaining the cross-section of stock returns. And by the way, for everyone in this room, could also probably lead us to better trading strategies. So first today, I am going to talk about why this paper does matter so much, talk about what we already know on these issues, what we learned from this specific paper, and at the end, I'll offer just one suggestion. So why is this paper important? It's because intangible capital is very important and increasingly so. Here's one way to see it. Let's think about what capital looked like 100 years ago. Here are the 4 largest companies in the US 100 years ago, and below each one, I've listed what I would consider the company's main economic assets. And I've written those assets in black if they are physical assets, and in red if they're intangible assets. So let's look at US Steel. It had steel mills, large amounts of mineral deposits, a lot of trains, and a lot of ships, very physical assets. Take Standard Oil of New Jersey, which later became Exxon. Its main assets were oil fields, refineries, pipelines. Next, General Motors. In 1925, General Motors was like the Tesla of 1925. Um, so it had, I would argue that 2 of its main assets were intangibles. It had a suite of what were at the time very innovative products, at least like relative to riding your horse around. It had a portfolio of very valuable brands. Those are intangibles. But it also owned lots of factories. On the far right, AT&T, its main assets were telephone infrastructure, lots of factories for producing telephone equipment. So the economy of 100 years ago was dominated by physical capital. Let's see what capital looks like today. Here are the 4 largest companies in the world today. And you can see that their assets are mainly intangible. So take NVIDIA. I'd argue its main asset is its innovative products. So here I'm thinking about its semiconductor design and the related intellectual property portfolio around those. It also has created a system, an ecosystem of software, including a proprietary programming model, driver software. And it also has some very valuable long-term customer contracts with the cloud computing providers, with the big AI labs. So those long-term contracts are what I would call customer capital. It creates a very sticky customer relationship for NVIDIA that allows it to produce very high profits. Or take Microsoft, of course, its main asset, I would say, is its IP-protected software. It also has very valuable long-term customer contracts, for example, with the government. But it actually also has some physical assets in the form of data centers. And we all understand that as AI is becoming more important, actually the big companies are shifting back into physical capital as they build out these massive physical data centers. Or take Apple. I would say its main products are, or its main assets are innovative products, valuable brand, and I probably should have added software there as well. For Alphabet, the assets are software, data, and innovative products and that are very interrelated with each other. So we've moved from an economy of physical to an economy of intangible assets. Economist magazine put it this way: the world's most valuable resource is no longer oil, but rather data. And of course, data is a prime example of an intangible asset. That was true when The Economist wrote it in 2017. I would argue it's even more true today in the age of AI. So intangibles are on the rise. I've plotted that here. The vertical axis is companies' intangible assets as a fraction of their total assets. The dashed line shows the values for all companies. So back in the 1970s, about 40% of capital was intangible, and that's increased toward upwards of 60% in more recent years. And we all understand that in the high-tech sector and the healthcare sector, intangibles are especially important, and those are the sectors that are increasingly dominating our economy. So the problem is that our accounting system was set up and works really well for an economy that looks like this. Our accounting system, however, works very poorly in an economy that looks like this. The reason for that is our current accounting rules treat intangible investments as expenses rather than investments. One implication is that intangible capital is missing from companies' balance sheets. You should think of intangible capital as an off-balance sheet asset, and it's missing because we have this, I would argue, broken accounting system. Another implication of that is when we measure companies' profitability, we typically get numbers that are too low because we're subtracting off investments that we shouldn't be subtracting off. Let me illustrate that with an example. This is the example of Alphabet in 2024. It had $350 billion in revenues, $131 billion of cost of goods sold, so its gross profit was $219. But Alphabet spent almost $50 billion on research and development. For example, software development. That's spending that creates an intangible asset in the form of software, and that software asset is going to be missing from Alphabet's balance sheet. So I would argue R&D should not be treated as an operating cost. It should be treated as an investment. And you can say the same about at least part of SG&A, at least part of selling general administrative expense we could think of as an investment in things like brand or customer capital. So how does this matter when we start to compute profitability? Well, let's start with the Fama and French profitability measure that's underlying their profitability factor. They would measure Alphabet's profitability as 40%. They would take the company's gross profit, they subtract off R&D, they subtract off SG&A, so they're basically working with income from operations. So Bob's paper says, wait a second, we shouldn't be doing this, right? We should treat R&D and at least part of SG&A as investments. We shouldn't subtract them. So they propose these two other measures of profitability. The first one treats R&D as an investment. So there, the numerator of profitability would be the company's gross profit minus its SG&A, and you get a much higher profitability number for Alphabet, 55%. The second measure they consider treats not just R&D, but also 30% of SG&A as an investment rather than a cost. So there, the numerator of profitability would be the company's gross profit minus only 0.7 times SG&A, and that, of course, mechanically gives you an even higher number for profitability. So you can imagine, if you were to rank firms by these different measures of profitability, you're going to get a rather different ranking of firms. And when you then use that ranking to create profitability asset pricing factors, you could get rather different factors. So that's what this paper is doing. It's seeing how these profitability factors change with these, I would argue, and I agree with them, improved measures of profitability. But again, the overall argument, which I'm totally on board with, is we should be treating R&D and at least part of SG&A the same way we treat CapEx. You don't subtract CapEx when you measure companies' profitability. For the same reason, we shouldn't be subtracting R&D and maybe part of SG&A. So that brings us to what do we already know before coming to this paper? We know that there's a lot of research already on intangibles and asset pricing. More narrowly, there are already some papers that adjust the Fama French factors for intangibles. So the first one is by Eisfeld, Kim, and Papanikolaou. They focus in on the HML factor, the value minus growth factor. So here's what they say. They say, take HML. We've sorted companies by their book-to-market ratios. Market value is measured well, but book value of equity is mismeasured. It's mismeasured because companies have all these intangible assets missing from the balance sheet. So they're missing from book equity. They bring those back into book equity, and they compute a new version of the HML factor. They show that it has a higher average return and prices assets even better. Kai Wang, who's one of the authors on Bob's paper, does a similar exercise for the CMA factor of FUM and French. That's the factor that's low minus high asset growth, and similarly finds that adjusting that factor for intangibles makes it work better. Gulen, Lee Peters, and Zaccanini come along, and they take on all three FUM French factors, adjusting all three of them for intangibles, including this middle factor is just the profitability factor. It's the high minus low profitability factor. Today's paper is really just focusing in on that middle factor from FUM French 2015. So from all these papers, we know that adjusting these factor models to better account for intangibles, it makes the asset pricing models perform better. So that's something we already knew coming into today's paper. So I think that the challenge for Bob's paper is how can we say something new in light of these papers that already exist? I think Bob's paper does say quite a lot that's new. Here are the main three things that I learned from the paper. First, I do think it offers a better mousetrap. It offers an even better way to adjust these profitability factors for intangibles. Second, it sheds light on the why question of why does adjusting for intangibles make the profitability factor work better? And third, it sheds light on why profitability factors in general, or why profitability in general helps predict returns. So let me walk a little bit more slowly through those three. So first, why does the paper, or in what sense does the paper create a better mousetrap? What's the evidence? Well, it shows it in a few different ways. The simplest is to just imagine running a regression where on the left-hand side, you have Bob's proposed new R&D adjusted profitability factor. And on the right-hand side, we have some existing factors. And we're going to estimate the alpha of this new factor. When the existing factors are the FUM French 5, they find a positive alpha. And that's interesting because it says that incorporating intangibles into a profitability factor, it makes the profitability factor work better in the sense that it's helping us explain more variation in the cross-section of returns. That result is interesting, but it's not surprising because the Gulen et al. Paper already has a similar result. What was very surprising to me was this one. What if you set those existing factors to the FUM French 5, but they've already been adjusted for intangibles using the method of the Gulen et al. Paper? The new profitability factor from Bob, it still has an alpha even relative to that kind of state-of-the-art way of incorporating intangibles. So even beyond current methods, this new factor is better helping explain the cross-section of returns. Why does their adjustment work better? It seems to work better because Bob's paper, it's adjusting the numerator of profitability, but it's not even trying to adjust the book equity denominator of profitability. And for some reason, that just works better. Second thing is about why does adjusting for intangibles help? The answer seems to be that doing so provides us with a better forecast of future cash flows. You see that by running a regression of companies' cash flows in year T plus 10 on those companies' profitability today. And here are the R-squareds you get for three different measures of profitability. If you use the FUM French method of measure of profitability, which I would argue does it wrong in terms of intangibles, you get a 31% R-squared. The R-squared goes up a little bit if you treat R&D as an investment. It goes up even more if you treat part of SG&A as an investment. The third main thing I took is about why does profitability help us predict return? It seems to be that expectation errors are playing a major role here. And there were these three very interesting pieces of evidence supporting that. Number one, if you look at analyst forecast errors, kind of going back to very similar, echoing Sean's paper, analyst earnings forecast errors, they go systematically in the direction of the profitability anomaly. Number two, profitability does predict future stock returns, except if you control for future analyst forecast errors. So it's looking like profitability forecasts returns only through these analyst forecast errors. And third, you do see a profitability related spread in realized future stock returns. However, you don't see it if you look at ICCs. So these are implied costs of capital. They are proxies for expected future returns. So what that suggests is that the abnormal returns related to profitability were unexpected by investors. And by the way, those 3 points seem to work in the paper whether or not you adjust for intangibles. So it's really an unrelated point to intangibles. Great. So in my last bit of time, I want to offer one suggestion for the paper. There's been a recent advance in the measurement of intangible capital that could possibly make the profitability asset pricing factors work even better. And for those of you in the room, could possibly lead to even more profitable trading strategies related to intangibles. And the idea is very simple. It's just let's isolate the sales and marketing component of SG&A. So to illustrate, let's go back to the example of Alphabet. Let's unpack SG&A. There's a lot of stuff in SG&A. If you open up Alphabet's 10K, you see that Alphabet's $42 billion in SG&A was the sum of $28 billion of sales and marketing spend and $14 billion of general and administrative expense. So again, I should mention those two numbers are not in CompuStat. You have to open up the 10K to find those numbers. So what I'm going to argue here is that we should treat only the sales and marketing part of SG&A as an intangible investment, whereas we should treat the general and admin component as a true operating cost. So the proposed profitability measure I have is take Alphabet's gross profit and only subtract the $14 billion in general and admin spend. So, and I'm curious if that would make these profitability factors work even better. So why am I suggesting this? Why isolate sales and marketing? So here I'm leaning heavily on a new piece of research by Amr Sufi and co-authors called Investing in Customer Capital. This is a paper that I discussed just a few months ago at the WFA conference. So what do they do? The first thing they do is they get data on companies' sales and marketing spend from Capital IQ. So first of all, great news. You don't have to go through the 10Ks. It's sitting there in Cap IQ, even if it's not in CompuStat. They then interpret sales and marketing spend as an investment in customer capital. And I think that makes a lot of sense, actually. Think back to NVIDIA. Think back to Microsoft. I argue that some of their most valuable assets are these very sticky long-term customer contracts. Right? I would call that customer capital. That customer capital did not come for free to NVIDIA and to Microsoft. It was the result, I would argue, of massive amounts of spending on sales and marketing. So then what these authors do is what they find anyway, is they show that companies' past investments in sales and marketing help explain statistically companies' valuations. However, the leftover part of SG&A does not help explain companies' valuations. So the message that Amr Sufi and co-authors draw from that is, it's really only the sales and marketing part of SG&A that is an intangible investment. And by the way, sales and marketing, these numbers are very big. They show that 18% of companies' total capital is coming from sales and marketing, and that's even bigger than the percent that's coming from research and development. So with that, I will stop. Thank you again, and thank Bob for such an interesting paper. I recommend it to everybody.
We'll give Bob a chance to respond to Luke, and then we'll open it up for questions and comments.
Well, first of all, I'd like to thank Luke for his thoughtful comments. In terms of why the not adjusting the denominator might work better than adjusting, our interpretation, we show some results in the paper, is that both the numerator and denominator are error-prone variables. But when I have an error-prone variable in the denominator, that could really mess things up if there's a lot of error in there. And if I take two normal random variables and divide one by the other, you can't even guarantee that the second moments exist on that. And so that we show some results like that. A conundrum on the mispricing is, well, why does it only happen on the short side? That's something we haven't quite figured out. And this idea of just looking at sales and marketing from Capital IQ is definitely something that we're going to be looking into. So I really appreciate your thoughts.
Bob, just a quick question. Given what Luke said about intangibles are getting increasingly important, did you see better results in the later part of your sample?
That's when we divided the sample in two, we definitely got stronger performance of the factor in the second half, but the performance was still there in the first half. So our sample is from 1976 because the rules about expensing and reporting R&D went into effect in 1975 through 2023. So if I sort of equally divide that, the results are in both halves, but it is definitely stronger in the second half.
Question in the back.
Thanks, Bob and Rob. Do you think this effect have certain sector impact on it? Because intangible can be more sensitive to the IT industry, can be more sensitive to the intangibles, where the traditional material, they may be less sensitive to intangible assets. What do you think?
Yeah, I mean, so in their value factor, Eisfeld, Kim, and Papanikolaou sort of they adjusted on a industry by industry basis. The reason we didn't do that is if you think about the original Fama-French motivation for using the dividend discount model to sort of help you sort assets on implied cost of capital, there's no industry adjustment, and the industry adjustment doesn't make much sense in that context. We find that obviously there's some industries that the intangibles aren't important, so there's not much of an adjustment to their earnings so their earnings using Fama-French are very close to our earnings, whereas in the tech and the med area there's a much larger adjustment. So what you're seeing is that in the high earnings firms, you're seeing a much more predominant set of tech and medical firms.
Hi, thank you for sharing the research. I was wondering, does the research also try to adjust for the return on investment on these R&D spending and part of the SG&A spending? Because specifically, I'm thinking that about some of the hyperscalers and the large cap tech companies today. I think some investors are arguing that the return on investments for some of the spendings are actually declining, just given the large requirements for some of the AI spending.
Sure. Well, we didn't do any type of adjustment for that. It's hard to get that kind of data out of things like CompuStat. So our view is that if we had more accurate estimates of the productivity of these investments, we would love to make those kinds of adjustments, because it just gives you a better factor, because not all R&D is equal. Not all investment in SG&A is equal. So if you could sort on those things, incorporating into the productivity of those things, we would expect our results to get stronger. So in some sense, our existing results we'd expect to be weaker than what would happen if we made those adjustments. But we haven't done that.
Well, let me ask you a question then, Bob. And for Luke, where do you go to get it? This is alternative data. We don't want to adjust, shareholder common equity by some kind of capitalized R&D, but investing in a factory is just different from investing in a product, advertising that accrues value for Procter & Gamble. How do we get a better sense of it?
Well, we sort of in these cross-sectional regressions, we have in the paper, we didn't present it today, we sort of split out R&D versus SG&A. And in some stuff that's not in the paper, we didn't report it. We also did advertising. And so they have, you can measure that some by the cross-sectional predictability of future cash flows. So that would be one, and you could try to incorporate that into some present value relation. And the results sort of are in line with what you'd expect. R&D affects future cash flows much further in the future than SG&A or advertising. So there's some consistency there. So that might be one way to try to tease it.
But what about decomposing R&D? I mean, what's the hope?
Pardon?
How about decomposing R&D into different characters, right? I mean, there are 1,000 things that go into R&D.
Yeah.
I mean,
My take is that we're still very much in the early days
Yeah.
of measuring intangibles. And like you mentioned, alternative data are going to really help. Take a pharmaceutical firm. You can imagine scraping data on companies' announcements regarding their FDA clinical trials to better, more accurately depreciate the knowledge capital that they've created. I mean, I think we're still early.
right. Sandy Lowe's done a bunch of work, I guess, on things like that, and the predictability of clinical trial successes and so on. Yeah. Okay. Any other questions? Sean?
Yes, it was a really interesting presentation. So this is partly motivated by one of Luke's comments about the sales and marketing being incorporated into the current valuation. If I understand it correctly, for predicting returns, we almost want the piece that's not incorporated into the valuation, the piece that's not priced in, so that if I can predict the future profitability and it's not priced in, then I'm going to earn some kind of excess return. So, and consistent with the forecast errors results, kind of this evidence that it seems to be less a risk premia, but more a mistake or something that wasn't really realized. So I kind of have an open-ended question about your thoughts about whether this is just an improvement in data technology or in data management that people will improve over time and perhaps learn to predict profitability better when they're doing their valuations. And also, I was trying to follow how this fits with the option style up-down difference in the betas, if that's connected to this not being a priced in component of future profitability. But just an open-ended
Sure.
question for your thoughts there.
Yeah, great question. So if the interpretation is mistakes and people relying on GAAP more than, adjusted earnings, then the better your adjustment, so using sales and marketing instead of just some fraction of SG&A should help us in creating a factor. Now that so it's only half of the returns that seems to be related to mispricing, and that's on the negative side. So I think that's related to sort of when analysts might learn that they had biased returns. And so one thing that's consistent with our results is that they adjust downward more rapidly in a down market than in an up market. So that might explain the kink. But we haven't done any separate testing to verify that. So it's consistent with it, but we can't say that that's really what's going on.
Okay. Gentlemen, thank you so much, Bob and Luke, for a great presentation and a great discussion.